Welcome to the Freedom Capital Management Strategies Quarterly Market Review and Outlook. I'm Brian Zabora, Investment Director. I'm here with Pete Murphy, Chief Investment Officer. Pete, investors entered the first quarter pretty calm, pretty optimistic. You saw economies pretty steady and continuing to grow despite some headwinds. On the inflation front, we saw some moderation, as well as central banks potentially looking to cut rates. And also we saw, as far as market gains, we saw broadening out. We saw value stocks do well, small cap stocks do well in the US, international did very well, and we saw Magnificent Seven take a bit of a backseat. However, the second year in a row, geopolitical events took over. Last year, it was Liberation Day and the uncertainty around tariffs, and this year it's the conflict with Iran. Pete, could you talk about the implications of this most recent geopolitical events?
Absolutely. Thank you, Brian, and thank you all for joining us. As Brian said, it was really a 180-degree shift for the global economy and financial markets during the first quarter when the U.S. and Israel attacked Iran. And the biggest economic impact, beyond the impact of the war more broadly, was the effective closure of the Strait of Hormuz. And this has been something that has been widely feared in the global economy and financial markets for some time, but something that's never really taken place. It's kind of that red line that had never been crossed. Well, this time it did. And Iran effectively has shut down the strait, and we've seen that with a very limited degree of shipping that has moved through this very narrow waterway that has an outsized impact on the global economy because it is a significant area for the shipping of energy products, specifically oil and liquefied natural gas. Beyond that, refined petroleum products and fertilizer. It's a very significant and important economic area that has effectively ground to a halt. And so the effect of this has been a sharp rise in the prices of many of these key commodities. Most notably, oil prices are now above $100 a barrel and have been for some time. And we're starting to hear some echoes of consumer concerns about the inflation spike that took place in 2022. We're seeing gas prices in the US above $4 a gallon currently, and there's starting to be some rumblings that inflation may reawaken, which is something that was very disruptive to the financial markets and global economy just a couple of years ago. And in response to these rising concerns about inflationary pressures, markets are beginning to price a shift in interest rate policies from central banks globally. As Brian mentioned earlier, most central banks entered the year in the process of cutting interest rates and expecting to continue doing so. That has now changed, and most central banks are at least on hold, meaning they're not expected to lower rates anymore in the near term, and some central banks are even expected to begin raising rates again. So that has resulted in this tightening in financial conditions as interest rates have been rising, stock prices has been falling, and it's really created some consternation in financial markets. And so when we look at the first quarter, it really was a tale of two markets. We really can't just look at it as a singular event. We had what were markets doing before the attack on Iran and what were they doing after. And when we look at the first part of the quarter before the attack, financial markets really carried on what Brian talked about earlier, how investors entered the year. We had strong outperformance of international stock markets yet again, which continued a trend from last year. We also saw within the U.S. equity market this broadening theme continue with small cap stocks outperforming large cap stocks, value stocks outperforming growth stocks. So many of those themes from last year carried forward. In addition to that, we saw very strong returns in commodity and gold prices, another theme that was playing out from the prior year and continuing into this year. And lastly, we saw interest rates declining and bond prices rising. So a really healthy and constructive financial and market environment through the first, call it, 8 weeks of the quarter or so. But after the attack, as I just spoke about and as Brian alluded to, everything shifted within financial markets. Pretty much every major asset class declined after the attack, with the exception being commodity prices, which I talked about, energy markets, oil prices rising a lot, and the US dollar actually strengthened as well, which is a classic flight to safety asset. One of the surprising things we saw, though, was that gold prices, which usually do well during periods of consternation, gold prices actually struggled as well after some strong gains over the last year and a half. So some interesting market dynamics as well. The other shift that took place in equity markets is the U.S. stock markets once again began outperforming international markets after a pretty prolonged period of international outperformance. And then lastly, within bond markets, we saw interest rate pressures rise because of these inflation concerns. And when interest rates are rising, bond prices tend to decline. So we saw declines in bond markets. So we went from this very constructive financial market environment, pretty low volatility, prices rising in financial markets, to the complete opposite, with a lot more volatility in financial markets, asset prices declining, financial conditions tightening. So really a tale of two halves in the first quarter of this year.
Pete, that's great perspectives. Amid these challenges, what should investors be looking at?
There's no question, as we stand today, that the most important thing for financial markets and the global economy today is what ultimately transpires with the evolving conflict between the U.S. and Israel and Iran, and how lasting the economic damage will ultimately be. So to date, markets have been overall fairly sanguine in terms of their response and the pricing that's taken place within markets. So markets seem to be pricing a relatively short-lived conflict, which would be the best case outcome from an economic and financial market standpoint, and more broadly for sure. And so what we've seen so far is U.S. stock prices have declined from peak levels about 10%. That's a pretty normal correction. And if you look through market history, most years you'll see a correction of at least 10%. So nothing way out of the norm in terms of market reaction so far. In addition, we've talked a lot about oil prices, and this conflict has had a significant impact on oil markets, as I've spoken about already. But what's happening right now is that investors have repriced oil markets and oil prices much higher in the near term. When you look out later in this year, towards the end of the year, prices are expected to be back to the levels they were coming into this year. So oil markets are also pricing in a relatively short-term impact to elevated prices from this conflict. And then lastly, I talked about inflation earlier, and while near-term inflation expectations have risen, longer-term inflation expectations have been relatively contained and are relatively consistent with long-term averages. So far, while markets have had some volatility, it's been relatively modest in magnitude, and markets seem to be pricing a short-term and relatively short-lived conflict. So the greatest risk for investors at this point is that this more sanguine outlook that markets seem to be pricing right now proves to be a little bit too optimistic, and the conflict proves longer lasting and more damaging to the global economy and markets than many are expecting. Today, the answer to that question is unknowable, but today markets seem to be pricing that the more likely outcome is that this remains relatively short-lived without a significantly long-lasting impact on markets and the economy.
Pete, thank you for those insights. Beyond Iran, what are the key factors you're monitoring going forward?
Yeah, great question, Brian, because as we know, the financial media and news headlines have been dominated, and rightfully so, with the activities going on in Iran. And that said, there still is a lot happening in the underlying economy that is really consequential and important, and especially from a longer term standpoint. So when we look at the key factors that we are most focused on going forward as it relates to the economy beyond the conflict in Iran, the first is, will the U.S. economy once again prove resilient amid another period of disruption? So we've talked about this theme of resilience now for several years, and despite myriad events and myriad concerns, and as Brian mentioned earlier, it was Liberation Day, it was an inflation shock a couple of years ago, the U.S. economy has time and again in recent history proven resilient, and it seems to be likely to do so once again. For the first quarter, the Atlanta Fed's GDP Now measure is projecting economic growth to be positive and strong once again. We'll get the actual numbers here soon, but the U.S. economy still appears to be growing, and is relatively insulated from some of the direct impacts from the conflict in Iran, given that we are now a net energy exporter, which is a big shift from not only 10 to 15 years ago, but also from a few decades ago when we last had oil shocks and oil price shocks. So the U.S. economy still seems to be in pretty strong footing. The second thing we're going to be focused on is the strength of the U.S. consumer and the potential impacts of a softening job market. So as we've talked about in recent quarters, U.S. consumption is the most important factor driving U.S. economic activity. It comprises roughly 70% of it. And the U.S. consumer, despite all the headlines about consumer malaise and consumer sentiment being down, the U.S. consumer has continued to spend and has driven economic growth consistently year after year after year. It appears set to be doing the same again this year. And the big question for investors will be, as the job market has been softening, and it's not collapsing, it's softening. We're seeing much lower levels of new job creation, but we're not seeing significant numbers of layoffs, and we're not seeing sharp rises in the unemployment rate. But we are watching that job market softening closer because income is what drives spending, and jobs are the drivers of income. So that's something that we're going to be watching closely to see if this resilience themes will continue. And then the last piece of the puzzle, which is getting the least amount of coverage in the headlines, is the strength of businesses and corporate earnings in particular. So when you're investing in the stock market, you're investing in some compilation of businesses that are producing earnings. And so far, corporate earnings are expected to hold up strong. They're expected to grow at a double-digit percentage rate year over year yet again. And we're seeing continued strength in the corporate sector in the U.S.
Pete, thank you for those perspectives. Is there anything you'd like to leave investors with of how to navigate this current market environment?
Yeah, once again, as we talked about, there's a lot of headline risk, and that seems to be more the norm than not from a financial market standpoint. So the most important thing for investors is not to get consumed by some of the short-term headline risk. While these are consequential events from a geopolitical standpoint, for long-term investors, these events historically have tended to have a shorter-term impact on markets, and investors have benefited from staying patient and disciplined and allowing time to pass, not attempting to time markets, not attempting to respond to short-term events and reposition portfolios. So the most important thing for investors amid these times is to maintain discipline and avoid the temptation to time markets. The second thing that is consequential and important for investors is to stay diversified. Diversification is one of the most powerful tools for managing risk within an investment portfolio, and it's a way to increase resilience during uncertain times. So we continue to advocate a high level of diversification across asset classes, across geographies, across investment styles to better insulate portfolios for the unexpected. And then finally, as always, it's important to stay engaged with your financial advisor and to make your plan a living plan.
Pete, thank you for all those insights, and thank you for joining us today.
Thank you.